The money supply is shrinking at the fastest rate since the Great Depression. In fact, peak to trough, it's crashing at the fastest pace since the 1860s. So what does it mean and what comes next? The money supply measures how many dollars are in existence, and it's used to predict inflation. There are different measures of money supply, M0 through M3, each measuring a wider range. So you go from cash to bank accounts to CDs. When people talk about the money supply nowadays, they usually mean M2, which tallies up physical cash, checking and savings accounts, and smaller time deposits, CDs, and money markets. So why does money supply matter? Because printing more money means inflation goes up. You've got more dollars chasing goods, so each dollar buys less. Generally with a delay, since most money is saved. If it's parked in the bank, it may as well be buried in the ground. Until you spend it, at which point it bids up goods, which we call inflation. In fact, throughout history, that's been a danger of inflation. Like a drug, the benefits are immediate, the pain comes later. The government gets to print up $1 trillion, blows it on fast living, and it mostly goes into savings and then only gradually trickles out into spending, at which point you get the inflation. That can take years, during which government invents new excuses. So it was greedy workers that did the inflation, it was greedy companies, it was Vladimir Putin, or it was global warming. And that brings us to today. To finance COVID lockdowns, the Fed printed $6 trillion in fresh money, which sent inflation high enough to scare the Fed. Who knows, inflation makes voters angry enough to put a leash on them. And so starting a year ago, the Fed started reducing the money supply, mainly by letting the assets they had bought with all those trillions expire or roll off. So far, that roll-off has brought M2 down by close to $1 trillion. Now, granted, that's only 1/6 of what they printed, but the problem is historically, economies crash when you actually cut the money. As Chris Irons of Quoth the Raven put it, you can't taper a Ponzi. In fact, the last time money supply did anything close to today was the 1930s, when money contracted by almost 12% in a couple years. The kicker is that while we're only at 4% contraction so far, so that's a third of the Depression, the Fed is promising to keep going by that amount every year, so about $700 billion a year. If so, we are just 2 years away from a Depression-level contraction of the money supply. Now, that wouldn't automatically mean a depression. It took FDR's brain-dead socialism to make the Depression truly great, but at that point, we have to ask if Joe Biden is any better. The Fed at this point has painted itself into the biggest Ponzi of its dark history. If it lets M2 ride, inflation keeps going, but if it keeps contracting, it is flirting with the Depression. I fear we could get both. Today's topic was the winner of my weekly Twitter subscriber poll. To join and support the videos, visit my Twitter profile. Okay, we'll be watching. See you next time.